Okay, gross income from employment. Here is our lecture overview. And what is income from employment? That may seem like a silly question to ask. However, the answer might sound sillier until you really get into it. People who are employees have income from employment. So we're not talking here about income from people who work. We're talking about income from people who are employees. So our sole proprietors employees, no. Our partners and partnership employees? No. Our shareholders in a CRS corporation employees? No. Our independent contractors employees? No. So who is an employee? Determining whether the individuals providing services are employees or independent contractors can be a really, really big deal. And there's guidance from the Treasury Department, the IRS. The degree of control that the person hiring exerts over the person working determines whether the hiree is an employee or an independent contractor. So, it's not always clear cut. Now, hiring employees versus hiring independent contractors, what difference does it make to the employer? Why should the employer care whether they're classified as an employee or not? Well, having employees is a lot bigger hassle than hiring independent contractors. An employee The employer must provide a Form W-2 at year end. They have to withhold Social Security and Medicare taxes. They have to withhold federal income tax. And the employer must pay additional Social Security and Medicare taxes in addition to what is withheld. And the employer must pay unemployment taxes and workers' comp. And they may want to provide benefits to employees. On the other hand, if they hire an independent contractor to do the work, the employer must provide a Form 1099 at year end. Hey, it's a lot easier and it's cheaper to hire independent contractors. However, of course, if you need an employee that will always be there and will follow your guidelines on how to get the job done, then of course you need to hire employees. However, if you can, hire independent contractors. Okay, you need to be familiar with this Form W-2. This is the form that's given at the end of the year by employers to employees, showing the wages and withholdings and stuff that they've done during the year. This is a Form 1099 miscellaneous given to contractors. So, uh, to avoid additional taxes, interest, and penalties, hire independent contractors instead of employees when practical. Don't push it too far because you don't want to get in trouble either if the IRS ever looks at you, and you want to be fair to people. So if they really are employees, treat them as employees. Okay, Social Security and Medicare payments into the system. Unfortunately, talking about employees, we have to talk about this. Now, employees have Social Security and Medicare taxes withheld from their paychecks. 6.2% of wages is withheld as Social Security. 1.45% is withheld as Medicare. So, for example, if you have wages of 1,000, you're going to have Social Security and Medicare withholding. You'll probably have some income tax withheld. So the paycheck that you're going to get in your hot little hand is $683.50. But how much is included in gross income on the tax return? The whole $1,000. So you're paying income tax on that Social Security and Medicare withholding, even though you don't get the cash. And are Medicare and Social Security taxes deductible? No, they're not. Now, the combined Social Security and Medicare rate is 7.65%, but Social Security is withheld only up to the wage base. Now, I want you to be aware of this 7.65% number because you're going to see that referenced a lot in the textbook and otherwise, and that is the combination of the 6.2% for Social Security and 1.45% for Medicare. So, Social Security is only withheld up to the wage base. So, for example, in 2019, if you have an employee who earns $132,901, then you're going to withhold Social Security tax on $132,900. You will not withhold Social Security tax on that $1 that's over the wage base. So up until the Social Security wage base, you're going to withhold at a total of the 7.65%. After the employee reaches the wage base for the year, then you'll only withhold Medicare from there on out, which is 1.45. There's no wage limit for Medicare tax, so that'll go on as however much money they earn. FICA taxes. Social Security and Medicare taxes are called FICA taxes. So this is an important term. You're going to see it. You need to just know what it means. Employer has to match withholding from the employee checks. So for example, if $4,000 is withheld for Social Security and Medicare from employee checks, the employer must match it and send $8,000 to the IRS. So you can see that having employees are expensive, far beyond what you pay them in wages. There is also a Medicare surtax on high-income individuals, and that's 0.9% withholding on employee wages in excess of $200,000. And there is no employer matching on this surtax amount, so that's good, at least. Okay, let's just talk a moment about taxation of Social Security, people who begin to receive Social Security. So the taxation of Social Security depends on income, your modified AGI. So the higher your AGI is, the higher percentage of your Social Security receipts will be taxable to you as gross income when you receive them. Low-income people pay tax on a range from 0 to 50% of their Social Security income. Most recipients go to that you will ever see are going to be paying income tax on 85% of their Social Security income. This isn't the tax rate. This is Social Security. If you receive $100 of Social Security, then you will include $85 as gross income on your income tax return, and that 85%, you reach that at a very, very low wage, really, very low income. Is Social Security a good deal? It is not, but of course, as employees, uh, it's got to be withheld. As employers, you have to withhold it and pay tax on it. But it's really bad deal for recipients. And the higher your income is, the less return you'll ever get from your Social Security when you begin receiving it. Okay, let's talk about fringe benefits. Mainly, we're talking about qualified employee fringe benefits, which means that they meet certain IRS specifications for fringe benefits. And the employers can take a tax deduction. Employees do not have to pay some taxes or maybe no taxes on these fringe benefits. So this is the benefit of fringe benefits far and beyond just the fact that you have medical insurance. You as employees don't have to include the amount of that medical insurance, for example, in your income. So what makes fringe benefits qualified? Well, several things, but the things that we need to mention is that the benefits have to be offered on a non-discriminatory basis. So if benefits available to highly compensated or key employees are not available for highly compensated employees, the benefit is considered discriminatory and it will not receive favorable tax benefits. So it would be tempting to, for example, provide really good health insurance for employees that you value highly and not provide health insurance for employees that are lower level that are easily replaced. However, if you want to provide benefits that are qualify for favorable tax treatment, you can't discriminate against employees that way. And so here's your definition of what highly compensated and key employees are. So go ahead and stop and read those. I won't read them to you. Health insurance coverage benefits. In the U.S., we have the highest healthcare costs of developed countries in the world. Okay, so again, if we have qualified health coverage benefits given by the employer, we have a tax deductible. It's tax deductible to the employer. It's not taxed to the employee for Social Security for income tax, and it's not taxed to the employee for Social Security and Medicare taxes. Okay, let's talk about the Affordable Care Act employer penalties. So employers, full-time equivalent employees are employees that work 30 hours per week or 130 hours per month. So if a business has fewer than 50 full-time equivalent employees, there's no penalty for not offering health insurance to your employees. But if a business has more than 50 full-time equivalent employees, and if the business doesn't offer any health insurance benefits, there's a penalty even if one full-time equivalent employee is receiving subsidized insurance through an exchange. So in other words, you have a very high penalty as an employer if you have more than 50 full-time equivalent employees and you don't have health care coverage that meets the requirements of the Affordable Care Act. Then the penalty is $2,000 per full-time employee for all full-time employees except the first 30. So, tax planning principles: if an employer is close to having 50 full-time equivalent employees, try to keep the number below 50 and reduce the number of employees who work 30 hours or more. So, 30 hours is considered full-time for purposes of this Affordable Care Act. And I know lots of people, lower income people, whose hours got cut back to 29 hours so that the employer didn't have to provide health insurance. So this is an unintended consequence of this Health Care Act. Let's talk about cafeteria plans or Section 129 plans. In these plans, employees get to choose among the benefits. They can choose cash or qualified benefits. So you could just choose to have cash and not get a benefit, or you can choose to have, for example, group term life insurance, medical expenses, disability, child care expenses. And what happens is the employee voluntarily has some income withheld from the paycheck and put in an account to cover the chosen benefit. It saves income tax for the employee and payroll taxes because the benefits are excludable from income for those taxes. So, for example, before the employee established a Section 125 plan, Helen paid $500 per month to a daycare for her child from her after-tax income. Now, after the Section 129 plan was established, guess what? She still had to pay $500 a month to daycare, but she will be paying with pre-tax dollars. So here's how it works. She chooses to reduce her cash salary by $500 per month. She puts that $500, or the employer does, puts it in a cafeteria plan account for daycare. And the $500 used to pay for daycare. So she's still paying for the daycare. However, the $500 is not subject to income or payroll taxes. So she has converted after-tax expenditure to a pre-tax expenditure. And when we say pre-tax, employee doesn't pay income tax on the pre-tax dollars. After tax, the employee does pay income tax on their dollars. So here's just a little example to show how important, what a savings it is to pay with pre-tax dollars. So in this first column, she's paying with dollars that are after tax. So what this means is the employee has to earn $731. They have to pay income tax on it. This one is 24%. They have to pay Social Security and Medicare taxes on it of $56. And finally, they end up with $500 to pay for daycare. So they have to earn $731 in order to get $500. But if they can pay with pre-tax dollars, they only have to earn $500 to get $500 for daycare. So, it's a good deal. Now, qualified fringe benefits allow for payment with pre-tax dollars that are not taxed. Flexible spending accounts are a type of cafeteria plan. Flexible spending accounts, they're similar. They're type of flexible accounts. Contributions are withheld from paychecks. The medical insurance, however, cannot be paid through flexible spending accounts. Amounts not spent or forfeited. The entire amount available is available at the beginning of the year, and there's no recovery by the employer if the employee terminates employment. So, entire amount available at the year. We'll have an example here. So Anne estimates that her medical expenses paid through her FSA will be $2,400 for the year. So she has $2,400 or $200 a month withheld from her pay. She saves income tax and payroll tax on the entire $2,400. Unfortunately, at the end of the year, she has only used $2,000 of the money set aside. Here's the downside. She will lose the additional $400 she had withheld from her pay. Now, there's some exceptions to that, but this is basically what happens. Well, gosh, why did she overestimate her medical expenses? In this particular case, she estimated $2,400 rather than $2,000 because She forgot that she can't use the FSA to pay for her dependent daughter's medical insurance premiums. No can do. So don't forget that. So take advantage of cafeteria plans, flexible spending accounts, and don't overestimate how much will be used. Also look at exceptions to that rule that unused amounts will be lost.